Hello everyone, so let's get started with today's short video. This is going to be FRM part 1, book 3, financial markets and products trading strategies involving options. We have seen some of the trading before, strategies involving bonds, etc. So now we're going to jump into using options and what are the trading strategies. So the reading has 3 key objectives, right? What's the covered call and protective put strategy? So this deck, as I said earlier, so we only cover one of the objectives in these videos out of the LOS, right? So obviously when you join FinTrainers, we will cover all of it, both online as well as in the center. But for these YouTube videos, we are covering one of the key elements in each of the LOS. So this deck has material related to the payoff for the various spread strategies, right? But I'm going to probably use the whiteboard and talk a little bit about covered call and protective put strategies as well, because I feel those are relatively important as well. And I think understanding that will also help us understand and dive into the spreads a little bit more in depth. And we also going to talk about combination strategies and how the payoffs for them will be there. So that's a slightly more advanced, and we will leave that for the in-center and online live classes. Okay, so before we jump into some of the spread strategies and the payoffs, such as the bull, the bear spread, etc., let's go and use the whiteboard here. We will look at covered calls. I think the knowledge that we get from there will help us understand the bull spread. All right, let's get to the whiteboard. So we were just starting to look at the trading strategies. So the first thing that we're going to be looking at is covered call. So what's a covered call? Let's use some practical example to understand this, right? So as the name implies, it's using a call, right? And there is a cover in terms of the risk, right? So this strategy is created by buying the underlying, could be a stock or an index, and selling a call, usually at a strike above the current trading price. So let's look at this example of Reliance. So Reliance today closed at 2,418, right? July the 12th. So this is what we call as the spot price, right? So the spot or the current price is 2,418. Now what I can do is I can buy the underlying Reliance 2418 and I can sell a strike price of 2,500, and for that I get a premium. I get some money from the seller, right? So I am selling the 2,500 strike. Let's say I'm getting 10 rupees for that. So what that means is, so as the price of Reliance goes up from the current spot price of 2418, I begin to profit. And as it goes up until 2,500, I get to profit. But because I have sold the call, anything more than that, let's say it goes to 2,550, the price above 2,500, I will have to pay to the buyer of the call. Since I have sold the call, I have the obligation to compensate the buyer. But why am I doing it? I am doing this if I am mildly bullish. Okay, mildly bullish. I am not expecting Reliance to go about 2,500. At the same time, I'm also not expecting Reliance to go down a lot. So I'm expecting this stock to be trading in this range, and for this, I'm also getting an additional 10 rupees, right? So the max profit is strike price minus the purchase price, which is the spot price plus any option premium we have received. So in this example, the strike price is 2.5 minus the purchase price, let's assume is today's spot at 2.418 plus the premium received. So 2,500 minus 2.418 plus the premium received, which is 82 plus 10 rupees. So 92 rupees is the maximum profit in this covered call. As I said, this is when you are not extremely bullish but still somewhat bullish. Okay, so hopefully that was helpful. I used the example of Reliance, and now we come back to the slides. So we're going to jump into bull spread. So bull spread is also just like covered call, kind of a moderately bullish strategy. The good thing about bull spread is that you don't have to own the underlying, so your capital requirements are lesser, but it's kind of a near-term strategy, right? The covered calls tend to be you own the underlying, so it can be even for a longer term, whereas here you have expiry of the options, so this tends to be a moderately bullish but in the near term. That's a key difference. The way you can execute it, one of the ways is by buying a lower strike call and then you sell a higher strike call. Obviously the lower strike call is going to have higher delta, and so it will move faster with the increase in the price of the underlying compared to the one that you are selling. So in this example we are saying a 150 call is being bought, so you're paying $100, but then you're selling a 170 call for which you are earning a premium of 85, but end of the day you are paying a net 15 rupees. So it's a debit strategy in this example. This can also be structured as credit strategy. In that credit strategy, the example would be you will be selling higher strike put, and then you will be buying the lower strike put. So here the hope is that the puts, so again you can use put as well. Here the hope is that as the stock rises, it will close above the higher strike put. Anyway, in this example we are using the calls. So here what happens in the payoff is as the stock rises, the value of the the value of the call, the 150 call will go up more than the value of the 170 call. So the max profit is going to be the difference between the two strike prices minus the premium that you have paid. This is at the time of expiry, and in between you will, most of the time traders will close this position, right? But if you are hedging, then you would keep it most likely until expiry, and in that case the maximum profit will be the difference between the strike price minus the premium you are paid, which is what is shown in the payoff chart. So the maximum loss will be there until the stock remains below 150 in this example, which is going to be the premium that you have paid, the net premium, which is 15 rupees, and then as the stock keeps rising up, the loss gets cut, and at a certain point it becomes a positive, and the maximum profit is going to be the difference between the strike price minus the premium that we have paid. The bear spread is just the inverse of it. So you could do this with a put strategy as a debit strategy, and you can use a call as well for a credit strategy, just like how we discussed. Is just the inverse of it, right? Butterfly spread, it's a combination of a bear spread and a bull spread, and it tends to be kind of at least initially when you set it up, it can be set it up as a delta neutral strategy, and it's a great strategy for people who want to limit risk. It tends to be a low capital that's being employed when you utilize the strategy. The expectation is that the underlying will not move too much, right? So there is a narrow band in which the profit is made, so the probability of profit is lower, but again the capital that is being risked. So it's actually a very popular strategy amongst traders, amongst professional traders. And we're going to look at some couple of combination strategies here quickly. calendar spread. So here is just the same underlying, usually the same strike price but different time to expiry, right? Different months. So here what happens is there is theta decay. The holder profits from the passage of time. The holder also believes again the stock is trading in a narrow range, right? Dyno spread is similar to calendar spread, except usually they have distinct strike prices, not just expiry. It will be different strikes at which the spreads are created. All right, so we will wrap up here, and I will come out with another video very shortly. In the meantime, if you have any questions, drop a comment below, and all the very best with your preparation.